So now what we have seen is that India has recorded some unusually high numbers, I should say. Why unusually high? Because the numbers have come beyond what quote unquote experts were expecting. And there is also a talk about these numbers being inflated, but that's a technicality, and I can cover that with respect to this particular quarter. Um, Nevertheless, the big picture, it's not about this quarter. For several quarters now, uh, India has been the fastest growing um, large economy in the world ever since COVID. If someone likes records, and if you are a Virat Kohli, Sachin Tendulkar kind of person fan, then it will help us to feel proud to note that except for one quarter, Q2 FY24, India has been the fastest growing economy since the pandemic. That means we've consistently been number one. So if some deflation has happened, somebody is questioning the numbers, etc., etc., yeah, we can go and discuss all that. But the track record is clearly there. We have been the fastest growing economy despite all the challenges that have come. And going further back, uh, since 2005, that is 20 years down the line, our GDP has grown 4x. That means what was 100 is now 400. So we are currently at about $3.5 trillion, which is significant, which may also makes us the fourth largest or fifth largest, depending upon what you're looking at. And the story is not just about the past, it is also projected not by any Indian agency, but agencies like World Bank and IMF, that India will continue to be the fastest growing economy for the whole of FY26 and possibly FY27. We don't have projections for longer periods, say up to FY30, etc. But whatever numbers are officially available, India will continue to be the fastest growing major economy as per international organizations. Okay, just to put things in perspective, our GDP growth rate of current quarter, that is Q1 FY 25-26, that is current year, we reported 7.8% GDP growth annualized. Compare this with other BRICS countries. China is at 5.2%, Brazil 2.2%, Russia 1.1%, and South Africa 0.8%. So that 7.8 looks absolutely stunning. And if we want to pat ourselves a little more, Eurozone has recorded 1.6% growth, UK 1.5%, and US at 2%. So clearly what we are experiencing is a high growth area. And since this is consistently happening, it's the same like having a compounding effect. And therefore, the economy and obviously all its components are going to see the impact of this. Now, I've already mentioned about
Manoj, sorry to interrupt. You're able to see the screen share now, right?
Yeah. So we talked about this. Next slide. We also talked about this as to how we are doing much better than rest of the world. So let me go. Let's go to the. Now this buffet indicator. This is something that many analysts talk about, and this is considered like very critical in terms of evaluating whether a market is overvalued or not. Now, again, I am going to explain this with a lot more simplicity so that we drive home the point. Now, compare this ratio to P ratio of a company. We normally gauge whether a company is valued high or low, whether the stock is expensive or cheap, based on a number of number called P. Now we all know that it is not the only indicator. There are multiple indicators and we have to see a lot of things. But end of the day, we just look at this P number to get our first impressions on valuation, whether it is high or not. But as an analyst, you will go deeper and try to understand why this number is high or low, whatever. Similarly, for a country, whether the country's markets are overvalued or not, for that we compare it with income of the country. So the market capitalization of all the companies, listed companies, is divided by the GDP of the country, not the earnings of the country. Earnings of all the companies will give us the country P, but we are not looking at that. We are comparing it with the GDP of the country, and this number was professed by Warren Buffett, and that is why it is called Buffett indicator. And this number currently, India's number is at about 135, which again by our historical standards is very high. And therefore, a lot of analysts will tell you that Indian markets are overvalued. Now let us go one step deeper into this. Now, like it's popularly said that beauty lies in the eyes of beholder, I would stick my neck out and say, like beauty, value also lies in the eyes of the beholder. So you might perceive a particular thing, let's say a piece of art or a diamond, the value comes more out of perception. And we say that this is overvalued, undervalued, etc. by comparing the price with what we think is the value. Now, when it comes to this number, as I said, historically, this number is on the higher side, and therefore it is, many analysts say that, we should expect a correction, markets are likely to fall, etc. And that might happen. But let's see now why this number is high and will this number reduce to the comfort of the analysts. Now, in order for that to happen, because it's a fraction, either the numerator has to come down or the denominator has to go up. Numerator coming down means market correction, and that is what is being expected. Market will correct, therefore market cap will come down, so Buffett indicator will come down. Possible. The second reason how this number can go up is when the denominator is increasing. The denominator is the GDP of the country. And I just now said that we being the fastest growing economy in the world, the expectation is of the GDP growing faster, and therefore the actual people who put in their money in the market, they are giving a higher valuation to Indian stocks. Just like we don't look at PE, but we look at forward PE. Just like there is no one standard PE, but there are certain companies which always command a much higher PE compared to others in the same industry. Likewise, today the market is assigning a much higher value for the fundamentals of India. And to put it in perspective, let us look at the US. Now, if we think of the US today, we think of turbulence. We think of all things that are probably going wrong. Inflation going up, lot of uncertainty, not with respect to a change in political party, but the same person might keep giving different versions. So there's a lot of uncertainty with respect to policy. So actually the market should correct. But when we look at this particular indicator of US, it is close to 250, almost double of India. And this is not that it has happened today. Over the last 4 or 5 years, US has commanded a Buffett indicator number higher than 150. So what is happening is, while we are looking at one number, static number, and looking at that number and saying, okay, this is high, this is low, etc., the market participants are looking at it differently. Now, if we go back to India's P number for the markets, if we take Nifty's P, which is probably more relatable, that is in the range of, and I think Ram will talk about it later, that is in the range of 21, 22. So, while yes, like at any point in time, we can expect a correction, markets will cool down, markets can sharply fall. Looking at how things are and looking at the fact that money chases returns and those returns are generated out of growth, it is very likely that India will continue to have this number at a much higher level. And therefore, while we might expect a little bit of up and down like always, not something that we have to be overly concerned about. I do not anticipate this number suddenly falling to 95 or 105, etc., just because currently it is at a very high level. Next slide. Sorry I took a little more time, but no, this is another aspect which is talked about in India. We say, okay, GDP is all right, GDP is growing, but we should not be looking at GDP, we should be looking at per capita GDP. Now, what is per capita GDP? GDP is income of the country. Again, in very, 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 very simple terms, GDP is the income of all the people of India added. Okay, without going into the technical definition, etc., just think about it. All the people of India, if I add their incomes, that is equal to the GDP of the country. Now divide that by number of people in the country, you get per capita GDP. And this number has been very, very low for India. In fact, it is among the lowest if we compare it with other economies. And the reason is that we've had a very high population. All of us know that we are the most populous country in the world. So the focus is on whether on a individual basis are we growing enough. And thankfully, the numbers are in our favor. The per capita GDP of India has been growing again at the fastest rate. So we particularly post-pandemic era, we have seen a sharp increase in our per capita GDP. And today it is standing at about 2,600 odd, up from about 1,500 in about 10 years time and projected to touch about 2,900 by 2030. Okay, so there's a consistent increase in this number. Now, of course, this does not cover the aspect of unequal distribution. There is a Mukesh Ambani and there's a Manoj Trivedi, and both of them will not have the same income. Okay, but on an average, the numbers are increasing. So more share is going to Mukesh Ambani and less share is coming to Manoj Trivedi is a social issue that needs separate solutions. But from an economic perspective, the economy is continuing to grow despite increasing population, thanks to its faster GDP growth. And again, as I said, this number is much higher compared to other major economies. Next slide. Okay. So coming to global markets, now suddenly we are shifting from economy to markets, but this was in the context of the buffet indicator. So what has happened is over the periods, India's weight in the Morgan Stanley Composite Index of emerging markets, excluding China, there's one index, just like we have Nifty as an indicator of Indian stock markets, we have this very popular MSCI Emerging Markets Index for how the markets of how the emerging market stock markets are performed. And the index consists of companies or stocks from different emerging markets. And here, India's weightage has increased from about 8% in 2019 to now close to 20%. What does it mean? It means automatically more capital will get attracted to India because a lot of fund managers, particularly passive fund managers, will simply ape the index. So if there is a 20% weightage, then 20% of the fund has to come to Indian markets. So automatically there's a lot more capital coming in, and that is happening because there's a lot more confidence in the economy. Okay, we will see that we will keep hearing this news that FIs have withdrawn a lot of money. There is net FI outflow, and again, people who have been with the stock markets for a very long period of time will remember the times where any FI outflow would result in a crash in markets, and this kind of news kind of gives the impression that okay, now markets will fall because FIs are leaving the markets, which is not the reality of today. Today, it is the DFIs who are actually holding the market. FIs have been traders, will continue to be traders. They will walk in, walk out based on where they think they can make quick money. It's just like a trader taking bets. One day he or she will be bullish on a particular stock, and the other day the same person will be bearish on the same stock, maybe because the charts have changed or whatever. So that is how the FIs will be. FIs are not meant to park their money here and stay. And therefore, while there is a lot of churn that is happening, the broad direction of money coming into India because of this particular index indicates that more capital will flow into the country. Okay, it will have its usual up and down churn. That is what we have to accept and live with. And it is not just about Indian markets. I'm giving this analogy of US markets to dispel this thought that something which is overvalued or valued very high is destined to crash. That is not necessarily happening in today's markets. Yes, eventually it may happen, but if we are looking, as I told you, if you look at US, you will not see a lot of positives there. But if you see US markets, they've been on the continuous bull run. Markets have only strengthened. That is because of the perception of strength in US stocks. So we can probably go and keep
Yeah,
discussing,
Manoj.
but I think I'm taking a lot more time, so I'll probably skip this. I think I've made this point, and time permitting, I'll come back. But maybe we should go to the next, and you can talk about the Indian markets.
Okay. So you can turn off your video, Manoj. So I'll cover now very specific data on how the markets in India have been doing and the trend that we are seeing, the unmistakable trends that are coming out. And then we can proceed to the next section after that. So the last 1 year, Nifty has given a slightly negative return. But if you look at the overall trajectory, Nifty is on a consistent trend. There's a separate slide on manufacturing PMI. I'll talk about it later, but our market capitalization is around $4+ trillion. And what is happening over the last few years is that the valuations are getting better and better from an attractiveness perspective. All the PE ratios of the major broad indices are down from their peaks. And this is mainly happening because of steady earnings growth. Yes, of late, some of the earnings growth is not as per expectation, and maybe that is adding to the sentiment. But the sentiment that the world is becoming a more dangerous and a turbulent place, is already there, like Manoj Trivedi said. So the PE multiples are coming down. Indices have not moved much in the last 1 year. Therefore, there is a time correction. Earnings have steadily gone up. So therefore, PE multiples are getting better and better. And the Nifty small cap PE which was hitting a peak at in 2018, is now significantly below where it was. And similarly, the mid cap PE also is at a fairly attractive position. And so basically, there is also an increased market discipline, and therefore I would say that the outlook for next year returns is therefore slightly better because of the mean reversion that is likely to happen. Now, if you look at the actual levels of the indices, let us look at the broad index of Nifty 500. It reached an all-time high, sometime in the last 12 months only. Post-pandemic, yes, the indices have delivered great returns. But recent price action is suggesting that the markets are consolidating at these levels. And because they're consolidating, there is a time correction. Therefore, we are positioned well for a good upward moves as things get better. Uh, Hopefully, some of the uncertainty, etc., reduces. Hopefully, there is some truth behind some sort of an off ramp on the tariff, based on the interactions between the two presidents of the president of US and the Prime Minister of India. But I would say that broadly, there is decent earnings growth, and therefore we are positioned well going forward. Now, we also did uh, a ratio analysis of Nifty mid cap to Nifty mid cap 100, which is the market cap of companies covering market cap ranked 101 to 250. So that index divided by Nifty 50, if you see, this particular derived metric is continuously growing up. And it basically means that the mid cap space is doing better than the Nifty 50 space. I mean, it is kind of obvious, but it also reflects that at the top end, the large cap is not delivering as good returns as the mid cap. Mid cap is where a lot of action is happening. And this whole mid cap, small cap labeling is some sort of I wouldn't call it a misnomer, but given that the company's market caps are now several $billion, whether you take the largest small cap or the smallest mid cap, we are talking of pretty large, companies with tens of thousands of crores of market cap. So that that trend is likely to continue. Markets are definitely showing greater depth, which is somewhat deviating from the picture that US has, as Manoj had painted. US may market is somewhat concentrated. Today, the Max 7 have been giving higher returns than the rest of the market. So the tension there in US is definitely high, whereas in India, the rally, the multi-year rally is somewhat broad-based, and we are showing a more stronger foundation. If you look at these ratios, the second ratio is Ulta, Nifty 500 and Nifty 50, but there is a broad market that we are seeing here. Now, if I move to the next picture, which is again the CNX small cap index versus Nifty, here again there is, the small caps are outperforming the broader market, and there are various peaks there. So this is again another interesting cut. We looked at within Nifty 50, an equal weight index versus the Nifty 50 itself. As you all know, the Nifty 50 index has different allocations. For example, HDFC Bank may have a double-digit allocation, whereas a different company, let's say Shriram may have a lesser, or a Shri Cement may have a lesser allocation. The equal weight index basically gives exactly equal weightage to all the constituents of Nifty 50. And that also, if you see over time, it has delivered 25 to 30% higher returns. And especially in the last few weeks also, again, it is kind of, last few months, it is going up. It again shows that this trend of the smaller mature company, relatively smaller mature company doing better continues. So what it means for our portfolios is that in our jewel portfolio, now we are putting extra effort to look for those smaller companies uh, which are in the top 350 rank by market cap. We want to slowly over time shift the weightage towards the smaller of the top 350 so that we are able to generate better returns compared to just having a higher, market cap stock. So therefore, our divergence from Nifty 50, our endeavor is to continue to keep increasing it. And we're also deploying strategies to increase the beta when we feel that the market is poised for a move up, and vice versa, reduce the beta when the market is likely to correct. So that's the takeaway from this slide. And similarly, I would say the allocation between a jewel strategy and a spark strategy also, we are looking at various cases and trying, and if the client investor has the risk appetite and the tolerance for volatility, maybe give a higher allocation to the spark strategy within that. So the fundamentals and inflows are growing. And as you see, as the Indian Manoj talked about DIA, DIAs are pumping in nearly close to 28,000 crore every month. And that money, it can fill the large cap space and, probably even oversaturate it. And even those companies will be looking for smaller ones, and we want to chase them sooner than what others are doing. So that's why the Spark strategy would be an interesting strategy. Even the GEM strategy would be an interesting strategy for us as we move down the market cap ladder and identify quality companies which are doing well. Um, I won't spend too much time on this. Suffice to say that the long term, if you take a long term PE ratio trend, I mean, obviously 2010 was an aberration, and COVID was also some sort of a low. But the PE cycle today from um, uh, uh, the last 4 5 year time frame, if you see, we are kind of, the valuations are definitely attractive today. And a 19x to 21x PE range positions the valuations near the long-term median. So it's somewhat in that sweet zone between optimism and caution in the market. And historical data tells us that uh, whenever the Nifty PE has peaked as high as 28x, which was in 2008 and 2016, they were followed by a significant correction or a period of subdued returns or time correction, which is why it is very important for us to keep monitoring the valuation cycles. Also, the other chart on the right side, the enterprise value to EBITDA multiple, has climbed steadily from somewhere around 10x in 2010 to around 18 times in 2024, which shows that there is robust profit growth in India. There is improved operating leverage, and continued investor appetite for high quality companies. So there is a climate of definitely investor confidence, but also one has to have the discipline in terms of stock selection and risk management when in terms of monitoring these companies. Um, Manoj talked about this. The SIP growth in India is I guess in the next year it should touch 1 crore SIP accounts. Uh, Currently, we are at 9 million, and this is up from what it was just a few years back. Monthly DII net buying is also going up significantly, and many months it has been above 50,000 crores. And obviously the SIP book is also a big chunk of it. Whereas the uh, FII net selling has been uh, uh, kind of in many months it has even touched, it has gone above 35,000 crores. So basically, you can clearly see here that for the last 2 years, DIA flows have been consistently positive. And the surge in SIP accounts, shows that there is robust investor activity. And if we just peel this and see in the next slide what is happening, the SIP contributions in India, if you see the green bars here over the months, over the last year or so, they've never been negative. Uh, they've never been negative. They've been pretty robust. In April, there was a one-time cleanup activity that was done, but other than that, we are looking at a uh, uh, pretty consistent picture here. Um, so July recorded again the highest net growth of around 35 lakh new SIP accounts, which shows the investor confidence. Um, so the one-time adjustment in April was due to discontinued SIPs being cleaned up. Now with this, I will, the last 2 points I want to make here is about gold and silver. We have been advising investors to take exposure. In our PMS, we have proactively taken silver positions for some clients. And that is something that we want to mention as well, that, uh, you know, given the global uncertainty uh, and the geopolitics and geopolitics and egopolitics, both are happening today. And in that climate, there is uncertainty. And gold prices have surged sharply since 2023. And in September, they crossed, 1 lakh 9,000 per 10 grams. And this rally has accelerated over the last 18 months, driven by the safe haven demand that gold has amidst economic uncertainty. We are also monitoring China's gold buying trend, because China, every month, they release these numbers. So it's a good proxy. But this trend, while it peaked in late 2024, there has been volatility after that. And there has been some dip. Um, but the long-term charts do highlight that gold has delivered strong returns. And now let's look at silver also. Silver prices also have been up. They've also risen sharply since 2025, and recently they crossed 1,13,000. And this upward trend is mainly supported by robust industrial and investment demand. Um, the demand supply gap of silver has continuously been going up, and by 2030 it is likely to touch about 200 tons. And this, we believe that, while technically there might be some consolidation, but this trend is likely to go up, and silver's outlook is continues to be bullish. There will be usage of silver in electric vehicles, electronics, green energy, jewelry, etc., etc. So silver is like the cousin of gold, which is going up. So now we will get into the bonds and fixed income section. Over to you, Manoj.
Yeah, thanks, Ram. I don't know how much time we have, but let me. Uh, so, a lot of interest is now being generated because we see RBI cutting rates and a lot of new numbers come up. Uh, Obviously, many of us want to have debt also in our portfolio. So, looking at bond market also makes a lot of sense. But we will continue to look at it from a equity market perspective as well, because most of our investments, our interests are in the equity market. Um, okay. So what we have seen, Ram, again, I've lost the slides, but uh, what we have seen is that we have seen a drop in interest rates. Okay, this obviously is a no-brainer. Almost everyone knows that Indian interest rates in India have fallen. Okay, uh, but we need to go a little more deeper into this and see the implications of that. Um, what we will see is that while India's interest rates or yields have fallen over a longer time frame. The yields in the so-called developed economies, US, UK, etc., they've actually gone up, which means the spread, which is the difference between interest rates in India versus interest rates, say, in the US or UK, has actually shrunk. Okay, because our rates are coming down and their rates are going up, which is a positive for Indian markets. For someone who is looking at investing in India, lower the spread, lower is the risk, because the spread is essentially risk premium. If you are investing in so-called emerging economy, then there are associated risks which get reflected in higher yields. If these yields are coming down, if the spread is coming down, that means essentially the perception of risk is coming down, and therefore that's a positive sign for us. Now, what is run next slide? Yeah, this is very interesting, and this is probably not talked about much. Now, when we go to a bank to do a fixed deposit, you will see not one rate, but one big board will be displayed with interest rates for different time periods. Up to 7 days, 7 to 15 days, 15 to 30 days, 30 to 91, and goes on till after 5 years. That means at various points in time, the interest rates keep going up. And if you compare the two extremes, let us say interest rate for 15-day deposit versus a 5-year deposit, you will see that the longer time frame deposit invariably has a much higher return. Again, the reason is very simple. Greater the time period, greater is the uncertainty. You don't know what is going to happen in 5 years' time, but you are committing your money for 5 years, and therefore you want a slightly higher compensation for the additional risk that you are taking. So it's a given that higher time periods will attract higher interest rates. Now, that is true whether the borrower happens to be Manoj Trivedi or Government of India. But what we have seen over a period is that this spread between a 2-year government paper versus a 10-year government paper, and a 10-year paper versus a 30-year paper, you will see that the spread, that is the difference between these rates, is again coming down. In fact, you see that if you look at the chart, you see that there's a sharp decline in the difference between 10 to 30-year period time interest rates. What does it mean? What it means is that as a market, we are expecting much stabler interest rates. We are not expecting too much of fluctuation or sharp fall, sharp rise in interest rates over a longer period. That means not only is India perceived as a relatively less risky economy today, but also in future, over the next 15, 20, 30 years also, the market looks at India as a place where you can trust that place with your money. So the risk that was attached to India is consistently coming down. And as I said earlier also, this will again help in further attraction of capital. Okay. Now, another aspect of interest, which again linked to equity markets, we talked about P ratios, etc. And I keep explaining this. When we look at P and we say P of 21, 22, again somebody says P's are very high, etc. We need to look at P and understand it from the context of P of a bank deposit. We never talk about P of a fixed income security, but what exactly is a P multiple? Price divided by earning. So if, let us say, for example, and ease of understanding, if a bank is offering 10% interest on a FD, what does it mean? You have to deposit 100 rupees to get 10 rupees interest. In other words, to earn 1 rupee, you have to part with 10 rupees. That means the P ratio of a bank fixed deposit is 10. Now, bank fixed deposits, if we discount the probability of banks falling, etc., we normally consider banks as safe investments. So the PE of a safe investment is 10 if the interest rate offered is 10%. But what has happened over the years is that these interest rates have consistently gone down. And as this chart suggests, the interest rates are going to further go down. If that is the situation, and let us say a bank is now offering 5% interest, again, taking a simple, easy to understand example. So if I take a 5% interest, which is not too far away from reality, many banks are actually offering only 5% interest for your 30-day, 60-day, 90-day period deposits. Then the P of that quote unquote very safe, low risk investment is 20. And P of Nifty, which is an investment in more or less the top 50 companies of the country across 20 different sectors, is also 20. There is no upside potential for growth in a fixed deposit, whereas Nifty is probably offering you 15% plus compounded annually. So you cannot have low P's when interest rates are low. And if interest rates are expected to be lower, then P's are only expected to go higher. So today we are talking about, I very well remember when I was a student, there was this unwritten rule that if the P is below 15 or, around 12, then sell everything and buy the Nifty because you won't get that number. Now, if we look at our markets, despite all the FI volatility, etc., P is not slipping below 18. And as we progress, P's are not going to go below 20. And therefore, this perception about P's of, P in India being high, etc., needs to be looked at more objectively, looking at the current context. Ram, next slide. So this is what I had talked about. If you look at the trend, the top line, blue line, is India's 10-year bond yield, which is having a downward slope, whereas what you see at the bottom are 10-year bond yields of developed economies. And while the numbers are lower because they had a long era of low inflation, the trend is clearly upward. Even China is showing an upward trend. Germany is showing a sharp upward trend. So, and as a result, the important aspect is not what is happening to individual rates. The important thing from our perspective is that the difference is shrinking. And that is what I explained earlier with respect to risk perception again of India is changing. Next slide. This is again a different aspect, but nevertheless, for us, it is important to understand that, see, all these FI returns, etc., are dollar denominated. One of the reasons why FIs leave or exit from attractive markets like India is when they perceive a depreciation in the rupee or an appreciation in dollar, because their calculations are based on that. So, and if I brings in $1, and let us say, for example, that $1 is equal to 100 rupees, and that 100 rupees, let's say, gives 20% return in Indian market, so 100 rupees become 120. But by that time, let us say $1 has become 110. So that 20% return will drop down to, in dollar terms, much lesser, less than 10%. So whenever the rupee is depreciating or is likely to depreciate, dollar returns come down. Now, what is happening to the dollar? On the face of it, when we look at the dollar, we see the dollar strengthening. But if you look at the rupee dollar exchange rate, now there also you see a lot of fluctuation. And sometimes it goes up, sometimes rupee is appreciating, and then again it falls. Of course, like every other market, there is a lot of demand supply scenario which impacts this. But if you look at the bigger picture and this dollar index is an indicator of strength of the dollar. And as you can see in the charts, you are seeing that the dollar index is dipping. It is coming down. What it means is that dollar is actually weakening. Now, what that means is that if the rupee is likely to appreciate, then the dollar denominated returns of FIs will actually increase. Now, another indicator of dollar strength is what you see on the screen today in terms of what the various countries are holding as their forex reserves. We are not going to write an obituary to the dollar. The dollar continues to be the most important forex reserve component, but its share is coming down. Over the years, one of the reasons why we've seen a very sharp increase in gold is because central banks have chosen to invest in gold as part of their forex reserves rather than the dollar. So instead of holding the treasury bonds, banks, that is central banks, are preferring to hold gold. So you see that shift, and this also indicates weakness in the dollar. That means confidence on dollar is kind of reducing. Okay, we will not in the near term see dollar becoming insignificant. That is not going to happen. But a weakening dollar is an advantage for Indian equity markets.
So, yeah.
I
Manoj, I'll move to the
Yeah,
next section.
yeah. We are sorry, Ram. I'm taking a little more time.
No, I think it's fine. It's a Saturday evening. Let's see how long um,
Yeah,
we hold the
go ahead.
attention of our audience. So, so I think where all this comes to is like what Manoj said. Indian equity markets are going to be more attractive, and if you look at the earnings trend, clearly the mid cap crop of companies have been doing consistently well with a strong, touching up to 24% earnings surge in the recent quarters. And this is also reflected in what I presented earlier about the mid cap index being stronger than the other indices. Mid cap is where the strength is coming into play. Definition of mid cap, the largest mid cap company about let's say 7-8 years back would have been around 35,000 crores. Today it is touching nearly a lakh crores. So it has grown 3-4 times. So that is powered by this consistent growth that we are seeing of double-digit earnings growth, especially in mid-cap space for many years. Uh, Today's mid-cap company would have been easily a large cap company just a few years back, looking at the sheer size. So that is something that that earning trend is there. Obviously, last quarter, last 1 or 2 quarters has been a bit sober. And small caps have shown volatility compared to the large cap. Large caps, true to their nature, have been in a specific range between 5 to 10% of earnings growth. Small caps have gone up, and then there was a significant dip. There was a negative growth in 20. See, the small cap space comprises of pretty much every company beyond rank 251 down to 3,000, 4,000. So therefore, we actually need to take a cut of maybe 251 to 1,000, and we'll present the data next time. We'll do that further analysis and present to you how that segment is shaping up, because that segment is forming the universe of our Spark portfolio selection stocks. So overall, I would say that the earning growth signals a resilient Indian equity market driven by broad sector participation across market caps and economic recovery. So the other interesting slide here is the PMI index. So PMI index reflects the manufacturing and services growth. So it has also soared to multi-year highs. Uh, driven again by large domestic demand and expanding output across manufacturing and services. Um, uh, so employment is rising, new orders are rising, and while exports have moderated a bit, especially with the tariff tantrums, but the overall momentum continues to be strong, and a continued PMI expansion signals robust economic growth and a good confidence in various sectors. Now, I'll talk about specific sectors here based on what is being aided by policy tailwinds. And so, firstly, if you look at the capex trend of India versus government, government capex has accelerated sharply. It rose to nearly 2 trillion rupees in from 2015 2 trillion, it has gone up to 11 trillion. Last budget, there was nearly a 9.8% cut. But in spite of that, the long-term trajectory is very strong. Private capex has also grown, but the uh, the numbers are not as rapid as the government expenditure. So definitely post 2020, especially post COVID, the government capex has outpaced private capex because government has spent significantly on infrastructure, public investment, and other strategic sectors. And so last budget, government clearly said, look, we want this huge capex to be digested and we want private capex to be encouraged. And to that extent, the whole PLI schemes were also kind of launched to stimulate growth in various sectors. So that, if you see, that is indeed happening, and it is the PLI schemes are expanding. The idea is to make Atmanirbhar Bharat, Make in India, more sustained and uh, generate an industrial transformation. We have definitely missed the bus when it comes to semiconductors and a lot of other stuff, electronic stuff, etc. Now we are the idea is to if you see the spread where the budget allocated versus the real investment, the government has actually gone out and loosened the purse strings and spent huge money in areas which they are deeming strategic, where the aim is to increase India's global manufacturing share, accelerate innovation like in semiconductors, etc., and also create millions of jobs. And the idea is by 2030, they want to achieve some sort of a self-sufficiency. So there is significant investment happening in these areas. I'll not cite specific numbers in the interest of time, but we are monitoring this as well. And some of these movements are influencing our stock selection in specific sectors. The other notable trend that we are seeing is that power demand is surging and power consumption, you can clearly see the numbers. It's up from 1.3 trillion kilowatt hours in 2015 to an annualized nearly 1.8 trillion kilowatt hours. So what is driving this is rapid urbanization, industrialization, uh, more and more electrification of households, expanding digital commercial sectors, etc. So this we expect to see. If you look at the energy consumption trends, and again, in all the charts here, we have tried to compare India with other key economies so that we know where India is. And the heartening thing here in this slide on energy consumption is that the blue line is India here. The amount of the pace of growth is faster than USA now. You can clearly see that. And uh, while China is definitely way ahead, but then again, at least we know where China is. And we had actually written an article in our blog about 1 quarter back on this particular trend, and that is something that we are watching. I think one of our portfolio companies finances large power projects. Mr. Nilekani has been nominated to head one of the government initiatives to make the entire digitization of power similar to what he did with digitization of public identity and Aadhaar. So that's an interesting sector. Renewable energy is also expanding dramatically. Solar, the government's target is to expand dramatically from 2025, from 100 gigawatts to 300 gigawatts in 2030. One of our clients is the CEO of one of the companies in this space, and what I understand is that this is clearly definitely a hot area, and not just solar, but even the other areas like wind and hydropower, etc., are primed for growth. In terms of other infra, let's look at road and rail expansion also. This is also, I'll not spend much time on this slide, but again, significant spurt in infrastructure development and government investment in this area. The good thing is that better infrastructure here has a lot of ripple effects in terms of the growth in India. More and more reach into the hinterland and faster movement of goods. The GST cuts also can be seen in that more and more formalization, more and more traffic into the formal sector of the economy. So the other sector that we are tracking, and we've added one of the companies into our the jewel portfolio also in this space, is the hospitality sector, tourism sector. The key additions of hotel rooms in India is on a continuous upswing, as you can see. And the other on the chart on the left side, other than COVID year, we are seeing significant revenue growth in this space as well. So that is again an area of focus. I mean, there are a lot of complaints in social media that tourism is cheaper in other countries rather than India. So maybe it's an opportunity. Capacity is growing up, so hopefully prices will also become more affordable. More reach will be there. This is on tariffs. I think we've already covered a lot on tariffs in our posts, etc. But it's an evolving situation. The sectors that are most impacted, we know. So the 50% tariffs that US has imposed starting August 2025, it doubles more by, the 25% duties that were there are already doubled. This affects nearly 66% of India's exports to the US, which are valued at about $59 billion. And the sectors that are hit majorly are apparel, textiles, gems and jewelry, shrimp, carpets, furniture, etc. So overall, the Indian exports to US could fall. If things go the way they are, they could fall from 87 billion in FY25 to about 50 billion in FY26, which is a big decline of almost 43%. So a lot of jobs are at stake. And we know what the power dynamics happening between the two heads of state here. And there was a recent tweet just a few hours back from Trump that India is still a great partner. And then Modi ji also replied to that. So let's see how this goes and how much of good cop, bad cop both parties play with each other. But net, the impact of this could be up to 0.6, 0.7, even 0.8% of GDP if the exports weaken and there is reduced private investments. The good thing is that India consumption is a big factor of our economy. So we are at 65 odd percent. And with the GST reforms, the cuts, we could soon be 70%. So that somewhat makes us resilient to too much of this tariff kind of pressure. But let's see how it goes. Sectors like pharma, electronics, petroleum products may be somewhat exempt, but we'll see how the situation evolves. So now a quick wrap up on what this means to our investment portfolio. Manoj, you want to add anything here before I move to this last section?
No, Ram, go ahead. We are already overshot on time.
Okay. So so what we are doing is if you look at our Spark portfolio, there's an increased allocation to the smaller niche IT software and services companies. We are looking at companies with significant IP. As a corollary to this, in our jewel portfolio, we've exited all the IT majors now. IT is going through an inflection point. There could be spurts of growth depending on how they adopt AI and whether they move up the value chain, etc. But it's becoming somewhat uncertain there. Similarly, we've raised exposure in. I mean, these are one or two stocks in each portfolio, but specifically agri commodities, chemicals, maybe have added exposure. We've maintained and slightly increased the focus on manufacturing and engineering, reduced exposure to some of the financial stocks in the especially microfinance in the Spark space. And slowly we are reducing our cash allocation also because there is a time correction. Our expectation is that after this, the Diwali Navratri starts off. This in North India, they have this Pitru Paksh or Shraddh season, which ends by around third week of September. After that, the auspicious time starts, and we could see more economic activity at that time. And the GST new rates will also take effect around that time frame. So there could be an upswing in demand by October, November, coupled with Diwali. And right now, whatever purchases people are postponing because of the impending GST cuts, they will all kick in. So there could be growth. There could be a revival at that time, and then we want to hold less cash by then. So this is specifically sectors, and I'll again, this is on Spark. Again, we've somewhat reduced our allocation to banks and NBFCs here, and the increased focus on defense and defense-related companies. We are increasing. There is some correction in the defense index, and we are taking advantage of that. We are increasing our exposure. We are adding one shipping stock in that space. And we've boosted allocation to pharma healthcare also, especially company which is less immune to US exports. Like I said, we have exited the IT travel sectors and trimmed our allocation in cement, etc. And we are entering into some of the cyclical mature sectors there. So broadly, that is it. I'll move to the Q&A. And Manoj, there's one question. You can look at the chat window here. This is around the Forex reserves. There's a declining trend in Forex reserves. So what is the commentary there? Manoj?
Yeah, I'm just opening the chat. I mean, yeah, the Surendra Giri has posted this. Okay. See, 695 from 696. Forex reserves are not meant to be constant or growing continuously. There will be ups and downs. The long-term trend remains. Forget the long-term trend. We have enough Forex reserves. Okay, and this number is at a very, very comfortable position. We don't see anything to disturb this or to to fear that this number will drastically fall because there will be outflow of money, etc. So too small a change to really worry about or even explain. Okay, so just take it as a minor correction and not as a declining trend.
Manoj, you can turn on your video while speaking.
Yeah, that is okay. Now earlier it was not allowing me. Yeah. Okay. I hope I answered the question. Any other?
Raj had one remark on the road network. I'll take it offline with him.
Yeah. Okay.
The last 1 year, it's been flat. Yeah, we were looking at the longer term trend there. So any other thoughts, concerns, questions?
Ram, this is Manoj here.
Yeah.
I wanted to know that what is the right investment channel? Is it mutual fund only, where we need not manage so many things, uh, or because so much of volatility in the market, uh, putting any money in any stock, what I've seen is that it has not yielded anything last 4 5 months. So, what is your suggestion? Shall we stay with the mutual funds only, or we can try few stocks also? Certainly under the guidance of financial expert like you.
So, see, if you're doing stocks, if you're doing it as in an advisory model, then yes, timing of the right purchase and exit at the right time, they become considerations. But you could do them in a PMS kind of a model where the fund house, like I mean, like we do this, we regularly monitor on a daily basis. We monitor each stock. What is the news related to that stock? What kind of price action is happening? uh, you know, what are the volumes looking like? Is it hitting some sort of a resistance zone, consolidation zone? Is there an opportunity to add more? So we do a lot of tactical allocations and strategic allocations also based on that. So that's what we do actively in the PMS model. So PMS would be very convenient for you and very ideal to manage. Whereas in a mutual fund, uh, what we've seen about 7 8 years back is that when the market hits a zone, a consolidation like zone like what we are seeing now, many mutual funds, given their large AUMs, they take exposure to a large number of stocks. So therefore, the returns tend to become very patchy. In a rising market, everything is going up, so no complaints. But even in mutual funds, that tends to happen. So with stocks, yes, you can do advisory model where we advise you on a quarterly basis. You can ask her for advice and we'll give you. Or you can move it to a PMS model where everything is managed to you almost like a concierge service.
Okay, thank you. That answers my question.
Okay. There's nothing else. We'll wrap it up. Thank you, ladies and gentlemen, for joining the call. See you next time.
Thanks for a very nice session with a lot of knowledge. Thank you so much.
Thanks, Manoj. We've taken feedback and this time we've added a lot of pictorial stuff and charts so that it's easier to uh, uh, digest what is being thrown at you.
Yes, yes. No, it was fantastic. Thank you so much.
Thank you so much.